Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Well, I think it's a little bit like, the way that we would look at it as a human being, right? There would be certain things that we can glean from the past, right? So if you look at, for example, people are now talking about the 1970s and what happened in the 1970s with inflation. So people can look back and say, look, there are some macro things that we can learn. And there are ways that we can use historical data to backtest our strategies and to kind of predict what would be expected behavior, right? And we can test to see, can our systems, respond to a large data set, right? I mean, even as markets evolve, ideally we would like to have 100 years of data, right? That we could run all our systems through and be able to backtest them through 100 years of data. Now we could say back in 1921, markets were completely dissimilar to what they are today, right? But we would still love to be able to get that 100 years of data set to be able to run our systems through. That would still be a good test for the robustness of our system. But, so there'll be things that you could learn from that entire data set, but also there'll be things that you would be incorrectly take away from that. Like, in terms of how much the market microstructure has changed, right? So it's about being able to think about those two things at the same time.
Howdy, everyone. Coming at you around 10:30 p.m. here in Chicago to get our guest during his day down under. We've got a packaging company CEO turned PwC and Bain consultant turned AI-focused hedge fund manager, all from growing up in the chicken farming business in Australia. It's Howard Siow, founder and CEO of Taaffeite Capital Management. Welcome, Howard.
Thanks.
Good to see you. We were just saying it looks like winter there. That tree behind you looks like it's missing some leaves.
It's a cold day in Melbourne right now, actually. We're in the middle of a lockdown, so can't really complain.
So you're not even really supposed to be outside?
Yeah. So it's I think it's the last day of a 2-week lockdown because we had a bit of an outbreak here in the last couple of weeks.
You guys have been one of the stars, though, in terms of controlling it. At least Melbourne has, right?
Yeah, well, I think we had like 3 cases or something like that overnight, and people are freaking out about 3 cases. We'll get through it.
You'll get through it. And then you were born and raised there in Melbourne?
Yeah, so I was born in Melbourne, and yeah, I lived in Melbourne until I was maybe like 22, 23, and then I've been kind of traveling abroad doing things.
Yeah, that's one of my only spots I haven't been to in Australia. I've been Sydney, over to Perth and Fremantle, up at Surfers Paradise, but haven't made it down there. So it's on my list for sure.
Yeah, well, you should come by, Jeff. It'd be good to entertain you.
I think I'll come in our winter, though, in your summer. That'd be a little better. And tell me about this chicken farming stuff. That was fun to read in your bio there. So your dad was in the chicken farming business? Yeah,
so my dad, I grew up on a chicken farm. My dad owned a poultry egg business in Melbourne. So, I grew up there, ever since I was like 5, 6 years old. I was kind of helping out on the farm. I was, selling eggs by the roadside at one stage when I was a little kid. I was in the egg business kind of growing up. And then we kind of left the farm and I was around 13, 14 years old. We moved into the city as my dad was kind of expanding the business and decided it was better that I kind of had education in the city for a while. So kind of like from about 13, 14 onwards, I was kind of in the city. But, that, I was a little farmer boy.
And when I think of chicken I think you're farming the actual like meat, but you were just the eggs, or both?
So predominantly an egg business, but it's a similar business, right? It's an egg chicken rather than a meat chicken.
Right. So you can tell us which came first, chicken or the egg?
It still stumps me till today.
Awesome. And then you're I got in the back of my head, you ever seen Silence of the Lambs?
Not really, but I know of the film.
Yeah, and then she grew up on a lamb farm, and he gets into her head like, do you hear the lambs at night when they're killing the lambs? So I worry that you never ate chicken again after dealing with so much chicken, but hopefully you did.
No, love my chicken.
So then you got off the farm and you start getting your education. So what did that look like? You were at a university there in Melbourne?
Yeah, so I went to, I was kind of a Melbourne boy, so I went to Melbourne Grammar, then I went to Melbourne University. I studied engineering, software engineering, and finance and commerce finance, which is it's a double bachelor's degree at Melbourne Uni. I'm not sure if they still offer it till today, but I think at the time it was quite controversial. Like they said, why would you want to study finance as well at the same time as something like engineering, like software engineering? And it didn't make sense to a lot of people. But I think I was the first batch to graduate from that double degree. It's like, a 5-year degree.
And so kind of the precursor to today at like Cal Berkeley and stuff, they have these financial engineering degrees, right? So they've made it into one degree at a lot of schools now.
Right. I mean, back in my day, I graduated in 2001. So I studied from 1996 to 2001. Back in the day, I think we were the first graduate class of software engineering. So software engineering in 1996 was completely wild, that someone could start like a specialist degree in software engineering. So I actually started off my degree doing electrical engineering for 2 years. And then the last 3 years, they actually came out with the software engineering degree that I kind of pivoted to because I just enjoyed the whole computer science software component of engineering. And for my commerce degree, I gravitated towards finance because I thought it was very interesting. But because it was a double degree, the university actually allowed us to do a lot of things. So it was kind of a degree that was kind of split between economics and finance. And also we also did bits of, accounting, marketing, strategy and things like that. So, it almost turned into like a virtual MBA at that stage with a kind of a major in finance. But yeah, it was kind of like the first year that they would kind of offer such a bizarre degree, and everyone was wondering what the hell we would do with it. It just so happened to kind of
make it some future hedge funders. Which always amazes me. Many of the guests we've had, many of the people I know in the business, they have engineering backgrounds. A lot of the clients too, a lot of high net worth and family office people who get interested in alternatives have like an engineering mindset, right? Of like, okay, this is the ultimate puzzle. Let me figure out the pieces and try and figure out how to put it together in a certain way.
I think the thing that's interesting about engineering that I think a lot of people will talk about is that it's a very systems-based approach to life, right? So you learn about abstraction and you learn about kind of putting things into, abstracting them into boxes and breaking down very complex systems into simpler systems, and think of everything as, as a complex system that can be simplified into different abstracted systems. And I think that that's very interesting, particularly in the world of finance, which is, or economics, where these are immensely complex systems, and it requires, kind of an engineering mindset to be able to break it down. And I think it's very much like a lot of problems that we have. If you look at people that make breakthroughs, whether it be in electric vehicles or in, building a machine that can fly or a lot of problems, these aren't necessarily the smartest people on the planet. They're not necessarily Fields medalists or things like that, right? But it's about people that can work on very complex problems and commit to them for long periods of time. And it's about getting a lot of small things right. And I think, and I think it was, further in my career in management consulting that a lot of a lot of the solution mindset is about, you know, assembling the right team and being able to think about the problem correctly, and that the solutions were generally not a result of the most sophisticated, you know, mathematics or the most sophisticated AI, things like that, but it's about getting a lot of small things right.
And it strikes me like, is it the ultimate hubris to think like that you can solve the market, that it is even a solvable complex problem, right? Like, it's a little bit, if you had a machine or you have an engine or a drone, right, it can't fly 76% of the time, right? It has to fly 100% of the time. The engine has to fire nearly 100% of the time. But in the markets, you maybe only need to be right 50.46% of the time or something. So I can see both sides of it. Like, one, no way anyone could figure this out, no matter the computing power. But then two, you have people like Jim Simons, and you have groups that are figuring it out. So how do you think about that? Of like, it is that complex problem. You do have the solutions mindset, but do you believe there actually is one solution out there?
I mean, I think that, I mean, in terms of, you know, people ask this all the time, right? Can I build a system that can predict every move of the market, right? Every time the market, you know, something moves or something happens, you know, can you predict it? I mean, I think that almost by definition is impossible, right? I mean, I can't predict what will happen in the next hour, pretty much anything, right? Like, you know, is it possible to predict September 11 as an example? I mean, I think that's just fundamentally very difficult to predict, right? I think that what can be done, right, is building a robust system that's able to withstand a lot of shocks, right? But, you know, can you build a system that can predict anything? I think that's fundamentally, you know, fairly impossible, right? I mean, you'd be basically very rich if you could build a system that would predict what every participant in the market's going to do at any point in time, right?
Right, it's like Westworld.
And I think part of that is because that there are humans involved, right? Which is why markets have, you know, 10, 20, even 30 sigma moves, right? You know, moves that shouldn't happen in, like, you know, 10 lifetimes of the universe, and they happen every 5 years, right?
Yeah.
And that happens just because, you know, we have humans, and, you know, these are immensely complex systems, and when certain stars align, as they do every now and then, you know, things will collapse. And, you know, I think one of the most humbling things that I remember at the start of the, you know, when I first started TCM back in 2013 was, if you actually go back and have a look at how many strategies or how many funds have lasted more than 10 years, right? It's not a lot, right? Yeah. So back in 2013, there was actually not a lot of funds that actually existed prior to 2007, right? I think even today, if you look at how many funds that have been around for more than 10 years, it's very few and far between, right? And that's because, you know, because markets move in such kind of random and such, you know, as I said, 10, 20, 30 sigma moves, building a system that is robust to, you know, pretty much any eventuality is very, very difficult. And I think that's kind of the kind of degree of humility that we also approach the market. Whilst we are a what we call a quant macro system, so we do think about the market as a very large data set. We also superimpose on that what we call kind of fundamentals of the strategy. So things that, you know, we kind of had a look at what has blown up strategies over the last, say, 50 years. And we built that into a set of principles that we said that the system could never do, right? So that we would give ourselves, you know, the biggest buffer possible to ensure that any kind of huge tail event or black swan event that would occur, we would give ourselves a better chance of that not being our downfall to the system. So we data-led. We built on a set of principles, and I can go through that a little bit later as well.
Yeah, we'll touch on that later. But yeah, I love it. It's like you're building the least crappy set of many models versus the one best model to solve all problems, right?
Right.
So yeah, we buried the lead right there. I love it. We jumped right into it, but let's back to your background quick. So you went into consulting and then you said, screw that. I'm going out for myself. Give us the quick story there.
Yeah, so I mean, management consulting, I mean, it's a wonderful experience. I mean, you get to travel a lot, you meet, people and executives from all over the world. I mean, I think that's management consulting is a very
an expense
fascinating
account, right? Life's good.
right. But I think, a few things. I mean, I think the reality is of, for management consultants, is, you work on a lot of projects that are generally about, 3 months long in general, give or take. And at the end of the day, what you produce is kind of like a PowerPoint, right? It's a set of recommendations to a board or to some kind of committee, right? But ultimately, you are the person providing the recommendation, and they're the decision makers, right?
Right.
And I think after about 7 or 8 years, you decide, look, I don't want to be the person producing PowerPoint. I mean, I want to be the decision maker, right? And I think that there's some people are very comfortable in the advisory role, but I think I wanted to be the person executing and doing more with that, right?
Yeah, I love it. And what were some of your big clients there? Anyone exciting?
We can't really, we just generally don't talk about, clients, but I specialize in, I did the automotive industry. I did the energy. I did a lot of energy clients as well. So it was predominantly energy and automotive, and some telco as well.
And so somewhere in all of there, you kind of taught yourself coding?
No, I mean, like most of my coding background was from university. So, I mean, I did a 5-year degree in software engineering. So, most of that was from my university days. But I was trading in the background. I was building algorithms, trading the market with my own capital, since university days, right? So
you wish you could change places with the people in university today, trading GameStop and stuff, or you think you would have blown out? Think you would have done well or done poorly?
Well, I mean, I think that's it. I mean, I think that they have a very different mindset to something that I can kind of comprehend. I mean, I speak to people, for example, about crypto or these kind of various strategies that they have today. It's a little bit beyond me right now. They're kind of like, for example, how they're calculating their moves. I don't necessarily believe in it, but I'm sure something good will come out of all of this. By the way, I'm sure the next fund or something like that is founder on something that they're doing right now.
Yeah, let's hope so. There were just that data today, the most option volume like ever on GameStop. No, it wasn't GameStop. It was AMC, I think. Like 10 billion call options were purchased.
To be honest, I think the people that are really making money out of this are the high frequency guys, right? I mean, yeah. I know some high frequency guys in both, both in the option space as well as the crypto space that are making a lot of money right now. And I've got a feeling that it's actually the high frequency guys that are, the real money makers out of this whole, GameStop, Reddit stuff. I mean, I think I'm not sure what the spreads are, but I'm sure that they're making a very handsome profit on it.
Yeah, I think we're going to get like a Michael Lewis book within the next 18 months, right? Of like, here was the true GameStop billionaire or something.
Definitely out there.
And then speaking of billionaires, one of your former fellow coders went on to be quite successful. What was that story?
There's a gentleman called Cameron Adams that actually worked for me. He was a designer. I mean, he's gone on to be a billionaire. He built a business called Canva.
Canva, and what do they do?
They build. They have a platform for people to go in and design like invitations and things like that. So it's an automated platform for them to build. For people to do like design all online.
Right. You ever wonder like maybe that was easier if I'd gone that way and created something that right, I could get a few million people to pay me $12.99 a month to fix. I could be another approach at the billion mark.
Well, I did fund a number of startups in the technology space. you know, you know, I thought that I would be a decent, you know, a kind of, a decent investor when it comes to the tech space. But
Yeah.
I know it sounds very simple when you read the stories about, you know, people that first invested in Google or Facebook or things like that. But it's difficult. I mean, you know, building a tech startup is a lot harder. I mean, there's a lot of very, very smart people doing it. And it takes, you know, I think it takes an enormous amount of luck as well as talent. I think, you know, I tried my hand several times in investing in several startups, and I do think it's a very difficult space. But sure, I mean, you know, I certainly do believe that, you know, it's a great space for a lot of young entrepreneurs to get into, and I'm sure there'll be plenty more billionaires building the tech space.
Yeah. We did a blog post once. I think it was Apple's stock price in the 6 years after its IPO or something, and just kind of presented it like a hedge fund with no name or anything, you know, and the monthlies and the annuals, the drawdown. It was like negative 18% annual return, 62% drawdown. And where I was like, would anyone invest in this? Right. And the answer would have been no. Like, why would you touch that with a 10-foot pole? But there were people who believed in right then it was all about narrative. It wasn't about numbers at all. Just we believe they're going to get somewhere. So anyway.
Well, I mean, the interesting thing right now is because, you know, so because of the blowout year that they had in the last, you know, say in the last 12 months, there's an enormous amount of money that has gone into venture capital. And it's just one of those things, when you do have that much money kind of, you know, going into every opportunity out there, undoubtedly that money will generate winners, right? But, you know, the chance of picking those winners is difficult because, it's like everything else. It will have a boom and then a shakeout at some stage.
Fuel a lot of WeWorks as well, right?
Right.
So anyway, so then you decided to launch Taaffeite. So how did you think I want to get into the hedge fund space? You said I want to be a decision maker, but that's a jump from there all the way to like decision maker and managing other people's money.
Yeah. So actually, the process went so. So I worked in management consulting for about 7 years, and then after that, I actually moved to China to build a packaging business, which is one of my dad's companies. And I was working, you know, there for about 7 years as well, from about 2007, 2008 through to about 2013. You know, the really interesting thing, I mean, I had been in China several times. I saw the opportunity. I mean, I wanted to spend a bit more time there. And so, yes, I was the CEO of MyPack for about 7 years. And I was expanding both the sales base. So I was building the business in terms of the client base into Europe, US, as well as Asia and Australia, as well as expanding, you know, production there. So, you know, it gave me an opportunity to actually build the business. I mean, by 2012, 2013, a $40-50 million business in annual turnover. So, you know, we you know, I mean, I really enjoyed that time in China. But
where in China was it?
I was in Guangzhou, so in south of China.
Yeah.
Yeah, I mean, I thought that was fascinating. You know, but you know, after about 7-8 years, I mean, I came home and, you know, for personal reasons and things like that, got married and things like that, and decided to try my hand in finance, right?
Yeah, but it was that simple. It was from packaging company to finance, or were you?
Yeah, I mean, it was a little bit more complex than that. I mean, you know, actually at the time I moved back to Melbourne, you know, for a girl, right?
Yeah.
I mean, it didn't work out, but, you know, I moved back for a girl.
There's always a girl.
Yeah. But then I incidentally met my wife, and then, you know, I actually ended up settling down quite quickly. Yeah, so it was, you know, all's well that ends well, right?
Yeah. But were you reading like stories of all the like I'm forgetting his name now, but who called like the Big Short guys and all that, and you're like, okay, I got to get on this side of the equation with all these guys who called the 2008 crash or making money in China?
No, I mean, I think,
Or
you
you
know,
just
look, I mean, look, the reality with China, right, is there is an enormous amount of opportunity in China, right? But it is a demanding place, you know, from I'm talking about everything in terms of work life, everything. I mean, people, you know, we were working until, you know, 1, 2 a.m. in the morning, and then you're up at like 7 in the morning as well.
yeah.
You know, this is like 7 days a week. I mean, so it does become very demanding. And don't forget, you know, I was traveling. I mean, I was on a plane. I mean, I was on an international plane probably, you know, 5, 6, 7 times a month. And so, yeah, I mean, it just becomes very demanding after a while. And after doing that for like 7, 8 years, you just feel incredibly. I mean, I remember at the time, I mean, I was dating a girl, and she said, I've calculated something like in 2 years that I've been dating you, that, you know, I've only seen you for less than a month, right?
Yeah.
So it just becomes very, very demanding, from a work-life balance point of view. And at some stage, I think you decide that, you need to have some time out for a little while.
That's it. Yeah. My wife and I joke. She was a consultant. I was the one sitting at home. But before we got married, we did the same calculation. But we thought like, oh, that's why it worked. Like if she had to see me every day for the 2 years we were dating, she probably would have gotten sick of me. But when she only had to see me like once a month, it worked out. So then you start Taaffeite in 2013. And you guys have gone on to win a bunch of awards. You've done great. So give us the elevator pitch on how the strategy works. We touched on it a little bit there in the beginning, but let's back up and the elevator pitch on how it works.
Right. So what TCM does is, so we invest in a portfolio of across global, all the, you know, the major global assets, right? So our portfolio is 100 to 200 positions, right, across global equities, fixed income, commodities, and currencies. And this is across North America, Asia, and Europe as well, right? And there's no bias towards one asset class, so it's fairly well diversified across the 4 asset classes, as well diversified across the 3 major geographies as well. There's no one particular, you know, position that is more than, or we say no more than, you know, 5% of the portfolio, but generally speaking, it's less than 2% of the portfolio. And so, you know, the idea is having a very well, you know, diversified portfolio gives you effectively, you know, the best 100 to 200 positions, or the best 100, 200, you know, opportunities across the globe, right? And it's a nice, it's a nice kind of philosophically way, you know, to view the market, that you're owning, you know, very high quality opportunities and continuing to rebalance into the best opportunities. I think a lot of us ideally, you know, would like to do this on a discretionary basis. You know, for example, we think right now it'd be, you know, a great time to own some Tesla stock or some, you know, semiconductor stock or things like that, right now.
Yeah.
And I'd also like to own gold, and I like to own this to diversify and things like that. But being able to do this in real time is just very difficult to do because, you know, there's just too many instruments, right? I mean, we scan over 130,000 instruments to come up with this kind of optimal portfolio, right? So I think that, you know, it's always something that, you know, we would like to do on a discretionary basis. And I think everyone tries to do that, you know, tries to own a diversified portfolio that has great diversification. But trying to do this is a lot harder in practice than what we think it is, right? And it was a long process to actually get there. As I said, you know, we started off in 2013 with this ideal that we could build something that would, you know, significantly outperform the S&P 500, and that would be something, you know, because a lot of things are happening in 2013. You've got to remember, right? We were just recovered out of the financial crisis. We were actually just entering a new wave of digital exchanges, right? So a lot of the products, for example, that we trade today, we're only really trading since about, we're only electronic trading since about 2000, say about 2005 to 2008, a lot of them started, right? And the volumes didn't really pick up until maybe 2009, 2010, right?
So we're talking about things like simple, like Euro stocks or E-mini or Hang Seng Index, things like that, or just electronic contracts?
If you look across, say the 130,000 instruments that we trade, the investment universe that we scan, right? A lot of the data sets only begin from about, say, somewhere between 2005 to 2008, right? Some of them do this, back to about, the late 1990s or like the early 2000s. But generally speaking, in terms of actually getting a very clean data set where the majority of trading was kind of done electronically, it's kind of around 2005 to 2008. And the main reason for that, how many of us, we're using a computer on a day-to-day basis, pre-2000. Not
right,
that
or trading off your phone, or right. Yeah.
Right. We forget, the iPhone was only really launched in 2007, right? Yeah. We had our Blackberries pre-2007, but, how many people kind of had Blackberries pre-2007? It wasn't a heck of a lot, right? So this kind of wealth of data was kind of exploding into the market, right? So, as a quant, as a quant system developer, being able to, have such a nice pure data set to learn from and to exploit was something that was quite new. And a number of other things were happening. A lot of the spreads were coming down. A lot of the transaction costs were starting to come down as well. That was opening up a lot of these systems. It was really the idea that there was a large sea change happening in the world of finance, and that we could still jump in now and be ahead of this curve, right? People were still only just starting to exploit this data by using, AI algorithms and a lot of machine learning kind of concepts, and a lot of, based on, data science and information theory and things like that. So, it was a fairly new space. But, even so, I think that a lot of the systems were still failing, right? Even if you look until today, how many pure quant systems are really performing that well today, right? So it's still a very, very difficult system that even 7-8 years later, that people are still kind of grappling with, right? We obviously feel that we kind of cracked that, and we made, several novel kind of advances in the field that, haven't been done anywhere else, for a few reasons. But it is still a very rapidly developing market. This confluence of using, information theory and database concepts together with new information sources that are coming out.
So lots to unpack there. Let me start with, right. So I hear you say multi-asset, multi-sector, multi-geography, and my brain goes to that's classic managed futures, kind of global macro trend following, right? They have their across energies, grown in the ground commodities, stock indices, fixed income, currencies, yada, yada, yada. So how does it differ from that kind of approach, from that kind of diversification, right? I'm assuming that's much longer time frame, but tell us how that differs from kind of a classic managed futures type, global macro type strategy.
Right. So if you look at so I think that's right. So if you look at the classic global macro, right, so that's all built on Harry Moskowitz's, market portfolio theory, right, which is this general concept that if you build a diversified portfolio that is, uncorrelated, right, you can improve the risk-adjusted return of that portfolio, right? But when Harry Moskowitz did it back in, I think, the early 1950s or late 1940s, right, he obviously had a fairly limited data set. So he was just thinking about diversifying it with, a simple equity and bond, index portfolio, right?
Right.
But what we have now is obviously a much larger data set that we can calculate that with. So that's one thing, right? We can think of uncorrelation in terms of, a hugely multifaceted kind of portfolio that he couldn't even fathom. And then you couple that with the computing power that we have to be able to calculate all these things in real time. We can calculate covariance and things like that in real time, right? And then probably the most game-changing factor is you combine that with the data science theories that we have today and the computing power that we have today, right? And that allows us to compute an enormous data set almost in real time, right? So so our strategy kind of has two components. The first one is, we analyze, a data set of about 130,000 instruments, tick data, but we aggregate it up to about minute data, right? And we create a probabilistic forecast around three things, right? We will calculate expected return, right? Expected volatility and expected covariance, right?
So for each of those 130,000 instruments?
Right.
Okay. For the next day, the next hour, the next day, the next week, all of the above?
No. I mean, it's done. It's done for multiple time frames out to about 8 weeks, right? So it's done from about now out to about 8 weeks over kind of across multiple time frames, right?
Yeah.
So as an example, for each price point in the future, you'll calculate. You'll assign a probability to each price point, out in the future, right? Or to each, to various covariance, right? Between the instruments out into the future, right? So what you get is kind of this three-dimensional probability density function, right? For each one of these instruments, right? And that's a function of not just that instrument's historical price and volume data, but it's looking at the relationship of that particular instrument's, price and volume with, all the other instruments in that data set, right? So it's a function of the other instruments in that data set, right?
Yeah. So I'll interrupt you real quick. So to me, it seems like we're saying a couple of things. One, like the traditional 75 market trend following portfolio, right? It's kind of restricted just by old habits or limited data sets, right? Like you're saying, hey, if I know those covariances in more real time and I can be more confident in the correlations between those, I could triple those markets. I could quadruple that data set, right? Without adding much more risk, because I can predict right? If it becomes kind of one trade, I want to make sure I don't have more risk by adding more markets. So to me, what I'm hearing is like the math has allowed you to kind of add more markets with not much more risk, or that's the goal.
That's right. Well, it's also about using these techniques. So the traditional sense is I use the historical data and I use the historical correlations to purely be a predictor of what the future correlations or the future returns will be, right?
Right. I only want one market out of the energy sector and one out of the grain sector and yada, yada.
Right. So you're not just looking at the historical covariances or historical volatility and price data. You're trying to make forecasts of the future returns and the future volatility, not just based on the historical price, but there's certain things. So, for example, if you look at people in the technical realm, they can see even though volatility may be decreasing, that may or may not be a predictor of volatility could soon break out, right? And so it allows us to look at future volatility or future covariances in a much more sophisticated way to make more accurate predictors of what they might be in the future, right? And I think that is quite.
Does it kind of create? Do you view it as like it becomes like a single trade? Like here's the trade today with all these 100 instruments together that's going to produce this tomorrow or this over the next week, and then it's dynamically changing each day. Of like we're going to add 3 here, take away 3 here. So it just is kind of this one single entity that has all the data running through it and predicting over the next 10 periods or whatever, what the next 10 are going to be.
That's right. Well, it's a little bit difficult to really ascertain what the system is kind of thinking at any one point in time. Like, if I look at the portfolio right now, in some cases I can see that, for example, it's it's kind of betting that, some price is going to mean revert, right? And in some cases, you can see that it's kind of betting that some movement is very strong, and it's kind of assuming that this momentum is going to continue upwards. So it's not really clear, if I'm honest, exactly why, just from eyeballing it, if it's kind of more of a momentum-based strategy, like you said before, if it's more kind of mean reversion. But
it's just doing that to maximize tomorrow's risk-adjusted return, right?
Exactly. But and we obviously are looking at the portfolio, every day, all day, every day, and it is incredible. We are very impressed by the quality of the portfolio, right? One of the things that is scary, when we did start, the idea was, it was a pure kind of data-driven system, if you like. And what was scary, sometimes a system could go, 70, 80% into one position, right?
Yeah, that's what I was just going to ask. Could it put on like every stock index in the world full long, and that's the portfolio heading into tomorrow?
Right. So exactly. At the start, it was actually getting quite scary. I remember, you'd be going into some kind of, event, right? Some kind of release that was pending, and some election or something like that, and you could see the system was extremely long into one position, and it was actually quite high leverage as well. In some cases, like 7-8 times leverage. It was like 70% in one position. And it was scary. We did get it right in some cases, but you could see that it wouldn't take a lot for it to go wrong. And so after, I guess the initial years, as I said, it was about, paring it back. So what we learnt to do was, and it was, through a process of maturity and maturing the system, was, as I said, we now built the system so like there's no single position that's as an example more than say 2% of the whole portfolio, right? And we build in these core fundamentals, and we say that even though we trust the system to be making very good predictions of the market, we have kind of like 5 major kind of risk principles that we say the system can never do. So, for example, it can never invest in a position that's more than 5% of the portfolio, and generally speaking, it's never more than 2% of the portfolio, right?
Right.
It can never have. It can never be biased in one particular asset class. It always has to be well diversified among all 4 major asset classes, right? It can't have a bias towards one geography, so it can't be all, Europe or something like that. It has to be well diversified geographically. It also can only invest in highly liquid instruments. So even though we scan a universe of about 130,000 instruments, our actual investable universe in terms of what, the instruments that it can invest in, generally speaking, this changes depending on liquidity day to day or month to month, is generally less than 4,000 or 5,000 instruments that we actually that provide us sufficient liquidity. And in some cases, it's like it goes down to less than 1,000 instruments that we actually can invest in at any one point in time, right? So we have liquidity constraints, and then we also have leverage constraints. The system isn't allowed to leverage beyond a certain point. So to ensure that that if there's some large left tail event, that we're also not highly impacted by that. And probably the last thing is the system needs to be neutral, right? And we say risk neutrality, not in a traditional sense of risk neutrality in terms of your long or your shorts, but risk neutrality in terms of your risk off positions have to equal your risk on positions on a volatility adjusted basis. So we kind of build these risk tenets in place. So what we're saying is, if you look at the major reasons that a lot of quant strategies run into issues, we want to take all of those off the table, and then we want to use, the best systems possible to then create the best portfolio after these principles are in place.
Right. So like ones that have blown up have ignored one or more of those principles in effect.
Right. I think if you were to trace back as to why a number of strategies didn't make it, for example, to the 10-year mark or beyond, is generally because of one of those things not going well.
Right. And what this just popped in my head. I have 7 other questions here, but do you ever, right? The one thing you can't protect against there is like the death of 1,000 cuts, right? Like, so maybe you've taken away the big losses, but maybe it could lose many times in a row over weeks or months, or right.
Right. I mean,
But maybe, right, that's preferable. Yeah, I'd rather have that than the other way.
No, I mean, it's a good point. I mean, right. So I mean, everyone wants to know, I mean, what is the kind of the weakness, right? So the weakness is, right, like in any other strategy, right, is that all your risk on positions and all your risk off positions across global markets and across all asset classes all sell off at the same time, right? So if you were to design the event, that would be a real problem for you. You'd look for maybe a 30 to 40% move across all asset classes. So you'd want to see things like equities sell off, and you'd also say you'd want to see equities sell off, say 30, 40%. You'd also want to see fixed income, like, I'm talking about government debt sell off 30, 40%. Right, and you'd also want to see commodity sell off 30, 40%. So you want to see precious metals, agri stocks, you'd want to see them sell off, and you want to see safe haven currencies and everything like that all sell off 30, 40% overnight, all at the same time. That, and when
you're saying you would want to see, like, if you were trying to break it, this is what you'd want.
Yeah, I mean, if you're trying to break it, right? Yeah. And it would have to happen quite quickly, because the system, as I said, everything's on a volatility adjusted basis. So as volatility increases, the system would naturally scale out of it, right? So it would need to, the volatility would have to be also quite high. So you'd need this all to happen very quickly.
Almost like March of 2020. Like many of those were in place there. How do you define that risk on, risk off? That seems pretty important, right? So is that the model defines it, the AI defines it, or you predefine it, right? Like, I'm assuming you're saying risk on is equities, currencies, whatever, commodities, and risk off is long bonds, long gold. And then your derivatives, like you're saying, of agribusinesses and stuff like that. But so that's predefined, or the model defines it?
So the model is calculating. So it's making three calculations for each instrument. One is expected return, the second is expected volatility, and the third is expected covariance, or the correlation between those instruments. So when we say risk on, risk off, that's the number three. Yeah, it was right. So the risk on would be exactly that. You have certain things like equities and certain commodities, certain currencies, certain even certain bonds and things like that that generally move to a more of a risk on kind of movement. And then you have the assets that are correlated to a risk off. That obviously changes over time, right? Like you said, in March 2020, you kind of do have what we say happens kind of once or twice every year. You kind of have these systemic events where just everything sells off, right? You just kind of have this rush to cash, right? It's kind of the end of the world. It happens once or twice a year. Everyone's like, look, I'm selling my gold, I'm selling my fixed income, and I'm selling my equities, and I'm selling everything, right? And everything just sells off. And yeah, I mean, I think, everyone just goes to cash, for a particular reason. I mean, we will scale out to a certain extent because there's a jump in volatility, but it's, we more or less will rebalance during those periods into things that are generally mispriced, very cheap, and that tend to kind of bounce first. So we don't sell off. We tend to kind of just rebalance down, and then when markets bounce back, we hope to bounce back a lot faster than the market.
And then, so say we had a bond-driven equity sell-off, right? Rates rise, bonds are down, and equities follow them down, which we haven't seen in 30 years, but right, that's a very real possibility. So eventually the models would recalibrate and say bonds is no longer a risk off, right? Or that's a tricky, it's a tricky proposition, because even in that scenario, they might be risk off in a sharp downturn, but there could be months long or years long downturn in both prices where the model may say, all right, that third leg, that third pillar, the covariance prediction is saying that's no longer a risk off market.
Right, exactly. So yeah, I mean, it is if you look at what has happened over the last few months, I think what is interesting is, inflation. Inflation is probably it's the first time that markets have really had to dabble with the prospect of inflation since, say, the 1970s. I mean, it has happened, for short stints over the last, say, 10 years. But it's the first time that we've really seen a clean data set into what price moves might eventuate from a potentially high inflation scenario, right? I am not convinced that inflation is going to be necessarily an issue in the short run. Certainly not for the next 2 to 3 years. I think that debt globally is just too high. Governments would just run out of money to continue stimulating the economy to create the inflation. I mean, I think that governments would love to create inflation if they can, but whether they have deep enough pockets to continue that inflationary stimulus, I think that is, it's arguable. You said Janet Yellen coming out and making a point about that. Jerome Powell also mentioned, he questions whether this inflation rally really has legs or not. I think a number of other people have questioned the real possibility. I mean, it's always a risk. I mean, you can never discount the risk of inflation, but it's certainly probably a little bit. It's not a worry that I think that maybe it's been exaggerated a little bit recently. But I think the interesting thing is exactly what you said, Jeff. There is the possibility that inflation-led downturn that could see, for example, bond yields rising and bonds falling at the same time as equity. I mean, if there is very high inflation, it could cause quite a large rotation in equities and even a downturn in equities as well. We speak a lot about this internally. What if anything should be required in the strategy change. Actually, in the recent sell-off, we did make some adjustments to the strategy. Now, we don't really get involved in obviously what the portfolio is choosing, but we can make certain decisions, right? So, for example, I can't, without really talking too much about it, I mean, one of the things that we do is, so I spoke about, for example, there being 4 major asset classes, right? One of the ways that we can do it is, as I said...
What are those 4 quickly? Equities, bonds?
So global equities, global fixed income, commodities, and currencies, right?
Right. Sorry.
So one of the things that we do, for example, in the commodity portfolio, at the moment, it actually does have quite free range within the commodity portfolio to allocate. But the commodity portfolio is actually quite diversified. There's obviously agris, there's precious metals, there's base metals, there's there's a number of kind of subcategories underneath that kind of commodity category, right? So one of the things that we have done is we've kind of asked the system to have a kind of a minimum kind of weight in there towards, for example, precious metals, right? And what we did find by doing that is it actually does improve the inflation robustness of the strategy over the long run. And we were only able really to achieve that by looking at the price moves that have happened over the last 6 months. It's a little bit more sophisticated than that, but what we do in the system that actually makes it more robust to inflation is actually quite interesting as well.
And that's a good point, though. Like, you just went through all that stuff, like Yellen saying this, Powell saying this, but really the model doesn't care what you think, even though you've designed it. You're not going in there and saying, oh, Powell's wrong on this, I'm going to code up some stuff to get more long bonds or more short currencies or something, right? So the model's doing what it does regardless of what you think.
Right. I mean, look, we do have a certain, background in terms of finance, and, we do look at the portfolio on a day-to-day basis and always want to make sure that it also always makes sense to us as well. And so if we feel that there is, something that looks very imbalanced, we'll obviously go back to the drawing board and say, is there a 6th or 7th principle that we've missed out on here, right? And it's a little bit like if you were trying to design, a self-driving plane, right? So a self-driving fighter jet, right? Would you just look at flight data, right? And use that flight data to design that fighter jet, autonomous software? I think it'd be a combination. You'd also want to talk to very experienced fighter jet pilots, right? And you'd also want to get their input and say, well, is what this jet doing here, does this also make sense, right? And so the idea is, we also want to have that check and balance. I mean, it's one of the dirty secrets, right, of the quant industry, right? We actually don't have, a little bit what we touched on before, we actually don't have that much data, right? We only really have about 10 to 15 years of really clean data to work from. So you have to look at that with a certain amount of humility to say, what we are building on is a prediction that the next 10 to 15 years will look fairly similar to the last 10 or 15 years. And the reality is that's probably not correct, right? Yeah. I mean, the markets are going to evolve in quite a significant way that we need to, really think about eventualities that could occur that the system is just not prepared for, right?
And that I jotted that down before when you were talking of data only back to 05, 08, right? Like that's a huge hole, right? There's for sure things that have happened and patterns that have existed that aren't represented since that 05, 08 period. But I like
right.
That's the human interaction. Yeah.
Right. I mean, you can get data older than that, but it wouldn't necessarily be very clean. If your quant system is working from, for example, tick data, I mean, the liquidity and how much the markets have evolved, since pre-2005 is significant. I mean, if you think about back in the 1980s when people were using, hand plotting, back to the, I remember, watching that special on like Tudor Jones, and poor Tudor Jones was like kind of getting someone's like chart each dot back in 1986, 87.
Yeah, we've had a few of them on the pod here. Tom Basso was a couple weeks ago, and he used to do it by hand. Yeah.
Right. So when you think back at those days and you think about, people were using these kind of technical patterns that were very profitable in those days, right? Now, if your system was learning back from data that was in the 1980s where, simple technical patterns were working, I just don't know how valuable that would be to a quant system anyway, right? Because a lot of those pricing patterns would surely not be profitable, in today's market, right? I mean, even if you look back, the patterns that were profitable 5 years ago are not profitable today. I mean, how many high frequency strategies, have, even the last two to 3 years have stopped working, right? So, the markets evolve, right? So to a certain extent, it's about lack of data, and, the other part is just evolution of markets overall as well.
And that's how do you square that, right? Because it's some firms, some quant firms are like, no, anything past the last 3 years or 5 years, irrelevant. Like you're saying, right? I think of it as like if you're an alien and you go back in time and you come from back in time to today and you're tracking a kid, right? And you're like, okay, where's that kid going to go after school? You're like, oh, he always goes to the comic book store. Except here in 2021, where there is no comic book store. He's going to look on his phone, or he's going to do this. So to your point of like, even if you know these really old patterns, they simply might not exist because of the modern market.
Right. Well, I think it's a little bit like, the way that we would look at it as a human being, right? There would be certain things that we can glean from the past, right? So if you look at, for example, people are now talking about the 1970s and what happened in the 1970s with inflation. So people can look back and say, look, there are some macro things that we can learn. And there are ways that we can use historical data to backtest our strategies and to kind of predict what would be expected behavior, right? And we can test to see, can our systems, respond to a large data set, right? I mean, if even as markets evolve, ideally we would like to have 100 years of data, right? That we could run all our systems through and be able to backtest them through 100 years of data. Now, we could say back in 1921, markets were completely dissimilar to what they are today, right? But we would still love to be able to get that 100 years of data set to be able to run our systems through. That would still be a good test for the robustness of our system, right? But, so there'll be things that you could learn from that entire data set, but also there'll be things that you would be incorrectly take away from that, like, in terms of how much the market microstructure has changed, right? And, so it's about being able to think about those two things at the same time.
But does the AI like self-reinforce itself? So, right, if it learned, say you did have those 100 years, would it start to teach itself of like the last 5 years are way more valuable in the model and just pick and choose, or it's always going to take the whole data set?
No, yeah, right. I mean, so definitely the more recent data is obviously a lot more valuable. Like even the data over the last, say, in the last 8 weeks, as an example, is.
But is the model dynamically adjusting how much of that data it's kind of quote unquote using?
Right. So it's continually updating it. So if there is a very large, move in the recent, say in the last 8 weeks, we'll certainly be weighting that considerably more than what happened, for example, 5-10 years ago.
Got it. And then I started thinking about the Go, the AI and the Go that beat the Go masters, the game. You've read that article, I'm sure. So, right, as I'm thinking about it in relation to this, most quants, it seems, are making, if they were the Go engineers for that, AI, they were just teaching it on all the players' past performances, right? Which is kind of in the market. Like I'm look at all the past market performance, but the AI, when they actually, the one that beat these guys, ignored all that. They just taught it the rules, and it came up with its own strategy. So do you think that's ever viable in today's world? Or you're saying if you just let the computer go and said, make as much money as possible tomorrow, right? Which it seems like what they did with Go, of like, here's the rules of the game, just go win the game. Do you think that's possible, or that leads to weird places, that leads to blowouts and whatnot?
I mean, I think that's a very idealistic way of viewing the market, right? That, whilst, Go is, I personally don't play it, but from what I understand, it's an NP, defined data set, right? So, there are an infinite possible, set of moves, and it is an extremely complicated, game to beat a human being in, right? So, if you think about the advances in AI recently, I think that is very significant. But that is very different to the market, right? The market has a far more complex set of moves that it can move in than even a Go board, right? So and being able to
win, right? Like, how do you win the game? Do you win next minute?
Right. Right. So I think it's, I think everyone that reads that would think, there must be a way to kind of apply this to the market. I am, we personally can't see it, but we're not necessarily, we're certainly not experts in that space. But gosh, I'd love someone to prove me wrong. I'm sure someone is working on trying to, use that, use those techniques and use it to kind of beat the market. And I wish them well. Our system is not about using the most sophisticated and most cutting edge AI. We think of this a lot more like an engineering problem. So if you look at, say, an iPhone, right? Now, the latest, say an iPhone 10, right, is not that, and if you look fundamentally from, say, an iPhone 1 to an iPhone 10, right? Yeah. Each new iteration of that iPhone, right, was an engineering problem. Like, it wasn't that large an upgrade from say 1 to 2 and 2 to 3 and so on, right? But if you were to pull out an iPhone 1 and compare that to an iPhone 10, that is a dramatically improved device, right? And I think
order of magnitude different, yeah.
Right. You could say the same thing for cars, right? Like, if you look at the latest, Mercedes-Benz, right? And if you were to compare that to the same Mercedes-Benz, like, 30, 40 years ago, right? it looks vastly different. But if you look at the new release that they have on every model, it's actually not that large. It's some kind of incremental engineering improvement between every release, right? And that's pretty much the same thing when you're developing quant systems, right? You're looking at the system as a complex system, and you're looking at what other things that we can do to improve on that system on a day-to-day basis, right? It's not about getting, a NASA scientist to work on a turbo boost to your Mercedes-Benz or something like that. It's not about coming up with some, quantum mechanics system inside your Mercedes-Benz. It's about, making these incremental improvements over time. And you trust that, as an engineering problem, as you make continuous improvements to that system, that the system improves over time. And a lot of the work and building systems, it's really about grunt work, right? It's about making a lot of small incremental changes over time.
That doesn't sell as well. It's not as exciting. Except if you...
I wish that we had some quant computer that could calculate every possible move in the market and solve it. But I mean, I'm actually, I'm skeptical that that's even possible.
Which do you watch the series Westworld?
I do actually.
I think that latest season, right? They had the thing that could tell exactly what each person was going to do in the future, and that they were taking them out. I think we talked about this on the phone before. The David Brailsford, Sir David Brailsford, is that his name? The cycling guy in England. But he wrote this whole paper on that, their cycling team coming into the London Olympics. And it was this whole concept of like, no, we're not just going to be like, we need faster people. We're going to make the caliper on the wheel a little bit better. And we're going to make this wheel design, and we're going to make the handlebar a little better. So all these incremental changes, the next thing you know, they were winning the Tour de France with Team Sky, and they did well in the Olympics and all that. So we'll put that in the show notes. It was an interesting piece. I can't remember the name of it right now.
Yeah. I mean, I think, look, the interesting thing about finance, I mean, people will always want to know, is there one system that kind of beats it all? I mean, I'm not convinced that, I mean, the markets are so sophisticated, right? There's certainly going to be, a whole basket of players that win, right? And there'll be a large basket of players that lose, right? The idea is you really want to be just in the top quartile, and be that over a long period of time. I don't think that the goal necessarily needs to be, number one every year, to be the winner. It's not really a winner take all market. It's a market where if you aim to be in the top quartile, every year for, like Warren Buffett did for, like, I mean, he did it in like for 60 years, but, for a long period of time, that you will come out on top. And I think that that's more realistically, what the goal is in building strategies, right?
Right. Just land the plane every time. Don't crash, right? If you crash on your last landing, no one will remember the 300 ones before that.
Right.
And then one last thought on the whole AI and the computer. So I've always had this thought, right? If everyone's using AI, if you have essentially the same software and same hardware, moving towards that where everyone has the same stuff, do you get to some utopia, or I don't know if it's a utopia or dystopia, where everyone's models are kind of coming up with the same answer, right? Like you have these principles, the next guy might not have any of the principles, but do the machines eventually become smarter and smarter and smarter where they all are arriving at a very similar answer to the market problem?
Yeah, look, I mean, people, the whole field of kind of data science or, information theory and kind of machine learning and things like that. I mean, this is a huge field of statistics, right? So, there will always, if you think of it as kind of this immense field, right? I mean, I think that there will always be people coming up with different ways to kind of model the markets and to make money off the markets. I don't think that there will be necessarily one model that's going to rule them all. So I think the likelihood of
You're in one model, but if like a set of 50 principles becomes right, bubbles up to the same way diversification and this and that has today. Excuse me. But yeah, you've answered that 17 different ways. So I'll let you off the hook on that one. Any other thoughts before we'll go into our favorites? I did have one more thing, unless you had something, but so the 130,000 instruments, does that include indicators like employment rates or cost of crude production in the North Sea? Does it include things like that, or no? It's all just market price action?
Yeah, so it's purely, we're only using the price and volume data for those instruments. And I guess the premise of information theory is that all information in the market is actually reflected in the price and volume data across the markets, right? So if there is some kind of employment data or some kind of news event, that will all be reflected actually in the price and volume data across that data set, right? Across that global data set. And in fact, it's actually a purer way to see that data, right? Than actually looking at, trying to look at, for example, employment or PMI numbers or things like that.
Yeah. So, and that, to your point of there's not one model, some other quant shop's sitting there looking at all of that data and saying, I'm going to predict what that data is going to be and where the price is going to move once that data comes in. So there's two ways to get in that camp.
Right.
And then you talked a little bit about the improvements. What was that, just getting those principles in there, or there was something else when you said there was kind of these improvements back 2-3 years ago?
Yeah, so I think it's a number of things. So, we made a fairly large pivot in strategy back in around 2018. That was more or less driven by trying to, reducing the leverage of the strategy, reducing the concentration of portfolios, as I said, rather than having 70-80% in one position. We want to reduce that down to, say, 2%, having a lot more positions, say about, 100 to 200 positions in the portfolio. So we wanted to, and increase the diversification across both asset classes as well as geographically. So it was about, really enforcing a lot of fundamental kind of financial principles into the strategy. And, we tried various things that, with fairly limited success. So we were trying to use, stop losses at one stage. We ended up not using them. We were trying to reduce the downside volatility before kind of waving the white flag and deciding that that wasn't the right way to go. Because, of various volatility in the market has increased in the last few years, that just makes using, stop losses quite destructive in value. So, we had to make various adjustments to the strategy, which is a humbling experience, but I think it's important to do. And certainly what we have, as I said, it's an engineering process, and what we have now is is a system that we're extremely satisfied with, right? I have over $5 million US dollars of my own wealth invested in the strategy, and I do it because I don't invest in any other strategy. I mean, outside of a few houses that I own, it's pretty much all of my liquid net wealth. And I invest in the strategy because, I know that this is a very high quality strategy now. But it did take time. It does take time to kind of build these strategies is what we've learned. And the strategy is likely to continue to evolve as the markets evolve. But we are very comfortable with where it stands right now.
Right. And it seems like everything we've talked about is don't, invest because you think the strategy as it stands today is the end all. Right? Like, it's exactly what we've been saying. There is no model that will solve everything, but invest in the group that you think is going to, have a good process and has the machinery and the tools to keep having it evolve and keep having it be dynamic.
I mean, I think that, at the start, it's a little bit ironic, but at the start, we had a very, we were trying very, very sophisticated things at the start. And, I think the reality is right now, we actually think of the markets a lot more simply than what we did at the start, ironically. right? We were trying very sophisticated things at the start that, arguably, actually build in a lot more tail risk. The way that we view markets right now is taking away a lot of that early complexity. But what we learned was that it actually makes it a lot more robust to external shocks. And, and based on the models, it's just a lot more robust a system.
And then I want you to apply your principles to your own net worth, because you have a lot of exposure there. Right? You're saying like the concept of diversification, you're like, oh, but that's twofold, right? You don't have any diversification in your investments, except that inside that one investment is a lot of diversification.
Well, yeah, I mean, like, it was built as a fully diversified portfolio, right? So if, for example, this was, say, a pure kind of commodity CTA that was only invested in, say, certain commodities, then sure, I mean, I would probably want to have a separate kind of, for example, equity portfolio, things like that. But the idea around this is that it is so well diversified in just 100 to 200 opportunities that it doesn't require kind of an additional portfolio out there, because it's already optimally kind of diversified.
So we'll just go quick fire here. Favorite Australian athlete?
Oh gosh,
Got me?
that's a hard one. I mean, I'd probably go Steve Smith, the captain of no longer the captain, but Australian cricketer. I kind of grew up playing cricket, so yeah, probably Steve Smith.
Love it. All right, then my next going to be favorite Melbourne sporting event. Don't they do an F1 race there, and they have the Aussie Open? What's the favorite event there?
If I had a favorite, it'd probably be the Boxing Day Test match. Once again, I'm kind of into my cricket.
I've never been to a cricket match. I highly recommend. Don't they last like days?
Yeah, so it kind of lasts up to 5 days. So yeah, honestly speaking, if you're not really into cricket, you might find it kind of goes on a little bit.
5 days. But still, I want to mark it off the list, right? I got to at least go for a few hours one day, see what it's all about.
Sure.
Favorite thing to do in Singapore when you're back in Singapore?
There's so many things. Maybe just going down to the beach club or something like that. Just spending time in the bars, or just whatever. There's to do in Singapore. And it's a relatively small city, but there's lots of things to do.
Have they opened back up pretty much all the way?
So actually, they're in lockdown right now as well in Singapore. They're hoping to kind of open up in the next kind of week or two. So we'll see. I mean, people are fairly optimistic. I mean, I think cases are down to about 10 cases a day. So we're also expecting Singapore to open up. I mean, for us, it doesn't really make that much of a difference, because we kind of, we're all sitting in front of our computer screens most of the day anyway. Yeah. So it doesn't really have that much of an impact for us. I mean, other than, kids going to school and things like
that. Is there a favorite book or podcast or other resource of someone could learn more about AI and machine learning techniques and all this?
Actually, one book that I actually learned a lot from was it was this not learn it, but I found it quite interesting. Was, I can't remember the name. It's a book on Jim Simons on Renaissance technologies.
Oh yeah.
I can't remember the man that something breaking the code or something.
The man who solved the market.
Yeah. I actually really enjoyed reading that book.
The great part in there, right, is they were losing money and they just had something wrong in the code. Remember that little section? Like, we switched the sign on the E-mini price or something, and they fixed that, and it was like, whoop.
I mean, I think it's one of the things that you kind of learn when you build this business, right? That you realize that even Jim Simons, for in the first 10 years, there were many times that he almost lost everything as well. And you realize, it's not just about, he wasn't like, he employed some, Fields medalist or something like that kind of broke it, right? It was about getting a combination of people that managed to solve, a series of problems that eventually got it right. It wasn't because he had the smartest guy in the world working on it. It was it's about the humility of the markets, or the humbling experience of building strategies. And it's about the persistence of going through that, of weathering like huge drawdowns in the first few years, but eventually kind of cracking. And like what they say in most things, people kind of give up. They kind of give up, just before they kind of get the breakthrough. And I think for us, I mean, almost a similar experience. When we went through various drawdowns, you almost give up, but you realize by persisting through, you kind of finally start to get to these major breakthroughs, right? I'm not to say that we're going to be the next Renaissance. I mean, I hope so, but it's hard to for anyone to kind of make that claim. But we certainly do believe that the right kind of dedication and persistence to the job is certainly the reason why we are getting the results that we get.
Love it. And then finally, ask all our guests' favorite Star Wars character.
Yeah, I mean, I'm not really a Star Wars fan, so it's a bit hard to say, but I think that there's a lot of kind of lovable characters in there. I mean, it's kind of a strange one. I mean, I actually find myself kind of drawn to kind of, Darth Vader. I mean, I don't know, it's kind of a strange, but I think that he has a certain kind of charisma on screen, and
well, he's the ultimate, right? All the good movies have the guy who can't be beat, right? Jaws, all those.
Right.
It's like if he touches you, basically you're dead. So that in those movies, right, that was the thing of like, oh my God, this thing is unstoppable, an unstoppable force.
Yeah.
All right, great.
Right.
Howard, this has been fun. Thanks. Hopefully it didn't take up too much of your day there in Melbourne. I'm starting to lose my voice midnight here in Chicago, so I'm going to get to bed, and we'll talk to you soon.
Great. Thanks for your time as well, Jeff, and we'll catch up soon.
Thank you.
The Derivative is brought to you by CME Group. CME Group is the world's leading and most diverse futures and options exchange. For more information and educational resources about futures and options, visit cmegroup.com.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.